Now we're back to perhaps something you're more used to, which is decoding SFDR, trends, challenges and opportunities. So please welcome to the stage Laurent Goyer, who is counsel from Shearman, and also Lisa Kleiman, who is another counsel. Thank you.
This thing. Yeah. Do we have slides on? Perfect. Excellent. Well, thank you very much, Lisa, for the introduction. As mentioned, we are both counsels in the A&O Shearman's investment fund and asset management practice. And today, we'll be coming back on everyone's favorite disclosure regulation, SFDR, but transparent disclosures in general, and we will have a particular focus as well on fund names and how transparent disclosure requirements have an impact on them. First of all, I would like to just give a brief overview of SFDR. I'm conscious that there's a lot of people in this room who are probably already familiar with it. And for those of you who are not, I apologize in advance because it's a relatively complicated regulation with loads of acronyms and so on. So I'll try to summarize it very quickly so that we can focus then on the funds name topic. So first, what does it mean? So SFDR is the acronym for the Sustainable Finance Disclosure Regulation. So it's a EU regulation that was voted in 2019 and came into force in March 2021. And the main goal of this regulation is to enhance transparency on sustainability within financial markets, and more importantly, to ensure that investors have access to consistent and comparable information on sustainability risks and impacts. So it applies to both financial market participants, financial advisors, but also to the financial products. So applies to both EU and non-EU entities to the extent that they advise on financial products in the EU. Coming back to our specific focus, so investment funds, as you know, Luxembourg is an important platform for investment funds in Europe and in the world, and which means that SFDR applies to both fund managers as the entities and the financial market participants, but to the funds themselves as financial products. You might also be familiar already with SFDR classification for funds. So just a brief overview again. I mean, the classification refers to the relevant article in the in SFDR. So Article 8 funds, which promote environmental and social characteristics, but do not commit to or have not made sustainable investments. There's also a non-official classification, which we call Article 8+. So there's also this aspect of promoting environmental and social characteristics, but also committing to reach a certain percentage of investment in sustainable investments. And then you have the top classification, so Article 9 funds, which also will also exclusively make investment in sustainable investments. For all the funds that don't comply with these classification, it falls within what we call the Article 6, which is the general fund, the general regime that applies to funds in terms of very basic disclosures, which also applies to Article 8, 8+, and 9 funds, but which don't have the same reach as for these other classifications. And what do we mean by disclosure? What does it mean in practice? So for the financial market participants, so the entities, and in our case, fund managers, it means that they need to make some disclosures on their website. So for instance, how sustainability risks are integrated in their investment decisions. They also need to include a statement on how they do their due diligence on these sustainability risks. They need to disclose whether or not they comply with PAI, so Principal Adverse Impacts, another acronym, and if not, need to explain why they are not considering them. They also need to show how their remuneration policy is consistent with the integration of sustainability risk. And at the level of the products, so coming back on the fund, there'll be a number of information that will need to be disclosed in the fund constitutional documents or offering documents, which we call pre-contractual disclosures. For Article 8, 8+, and 9 funds, there will also be some periodic disclosures that will need to be made on a regular basis. And also, the fund manager will need to make disclosures on its website regarding those funds. So where are we now in terms of SFDR? So it's a relatively new regulation, but to be totally frank, its implementation has not been smooth. So we're already talking about the next stage of SFDR. So there's SFDR 2.0 being discussed. So the EU Commission has been listening carefully to what the market is saying and the feedback that they've got. And amongst the things that they are discussing in terms of enhancing or at least clarifying SFDR, there's a reshuffling of the classification or products either with labels per strategy or product categories with minimum requirements. Also, there's a potential discussion about suppressing entity-level disclosures, and also a universal disclosure framework for all financial products that could be taken into account. So, and also in terms of the regulatory technical standards, what we commonly call the RTS, they're also being reviewed, and the European supervisory authorities I've been discussing this, and we can also expect changes in relation to PAIs and financial product disclosures. So I'm going to pause here on SFDR. As I said, I'm conscious that it's an extremely quick overview with a lot of technical terms and so on, but I'd like to transition to our main focus of the day, which is also linked to disclosure. So it's the trend of fancy green fund names. So before SFDR and even after SFDR, there was a trend, of course, for marketing purposes and to make funds more attractive, to use terms like transition, climate change, green in the name of the funds. And the issue was that the name didn't necessarily reflect what the funds were actually doing, which was creating a lot of confusion on the market. So, of course, we were to expect that there were going to be some changes, or at least some more regulatory scrutiny with regard to these topics. And Lisa, can you tell us probably a bit more about how this is being put in place?
Sure, thank you, and hello everyone. So basically, I would like to jump back also on those examples and citing the final report of the asthma guidelines, which was also referring to some statistics from Morningstar. Basically, as of end of October 23, when it comes to usage, 4,788 users were using ESG-related terms in their names, whereby actually 6% also use those terms being Article 6 funds. So there is some scrutiny now in relation to fund names. And one interesting justification in relation to this is to be found in the asthma consultation on asthma. So they said that the name of funds is a marketing tool. And I think this is very interesting because actually, even though that investors are not supposed to go beyond only considering the name, a fund name can nevertheless have a significant impact on their investment decisions. However, even though that the asthma consultation picked this up, it's not the beginning where fund names have been under observation. Actually, the first source of it can be found already in recital 13 of the SFDR RTS, whereby the Article 8 funds can promote actually their environmental or social characteristics also in their fund names. Thanks. Another step towards scrutinizing fund names, we need to go back to May 22 when the asthma supervisory briefing was published. Actually, in that briefing, asthma considered some principle-based guidance. One of the first aspects to be considered is that in general, fund names should not be misleading, which is very important. And then also, asthma strike out that when you're using ESG, green, or other sustainable-related terms, you should only use them when supported in a material way by evidence of sustainability characteristics, themes or objectives that are reflected in the fund's investment objective and policy. So the recommendations that ESMA laid down to the national competent authorities was in a kind of way to ban ESG terms to the extent that there are no binding sustainability characteristics for the fund. But in an illustrative way, what does it mean? So if you have an Article 8 fund using sustainable in its name, there is actually no legal prohibition to do so. ESMA already said it in May 22. However, they advised nevertheless to reserve those terms for Article 9 funds because those funds are making sustainable investments, or to Article 8 funds that are Article 8 plus. So not only are they promoting EOS characteristics, but they also commit to contribute a minimum to making sustainable investments. Another aspect that ESMA wanted to put forward is in relation to impact-used terms. A fund using impact should not only be compliant either with the characteristics promoted under an Article 8 or making sustainable investments, as this is the case for Article 9, but those funds should also be in a position to intend to generate positive, measurable social and environmental impact. After this ESMA briefing, the CSSF picked it up, and they basically reinitiated again the fact that information required under the SFDR RTS should not be misleading, and that the principle of this fact that information should not be misleading should also extend to fund names. And actually, the CSSF already expected back in March 23, when they published the FAQ, that funds should follow the principle-based guidance from the ESMA supervisory briefing, and also that they should align their investment objectives and policies with the name that they are using. Again, in the CSSF thematic review, the CSSF reinitiated what they already stressed out in their FAQ back in 23. So actually, it doesn't come as a surprise that just 2 days ago, the circular CSSF 24/863 confirms that the CSSF will apply the ESMA guidelines on fund names. Okay, so let's pause a little bit. I mentioned so many times this ESMA guidelines for fund names, but what are those guidelines? So let's break them through very, very quickly. We have a scope. The scope is actually UCITS, managing UCITS, as well as self-managed UCITS, but also REFMs managing REFs and self-managed REFs. There are certain financial products or products in general that are out of scope. So is this the case for funds that are exclusively subscribed through reverse solicitation. Now, the ESMA guidelines, they set out 6 categories of key terms, being transition, social, governance, environmental, impact, and sustainability. All of those key terms are non-exhaustively described under the guidelines, like, for example, in the context of the category transition, you can find terms like net zero or transitional. But again, all of those examples that are laid down in the guidelines are just examples, so they are non-exhaustive. In the context of the guidelines, you're going to have certain requirements. So by way of an example, you have a fund which has a name XY Green Fund. First of all, you need to make the assessment of the name. Okay, green. Oh, there is something I need to pay attention to. My fund has green in its name. So first of all, I have a quantitative criteria of 80%, which is applicable. That quantitative criteria of 80% is applicable to every fund using one of the 6 categories of the terms that I just described. In relation to the quantitative criteria, you need to assess the proportion of investments that are committed to meet the EOS characteristics which is applicable for Article 8, but also the Sustainable Investment Objective. This binding element need also to be disclosed in the pre-contractual disclosures. When it comes to the climate transition benchmark exclusions and to the Paris-aligned benchmark exclusions or CTB or PAP exclusions, things are getting a little bit more complicated because actually they apply to the categories, but they are not equally applying to the categories. What do I want to say by that? So the CTB exclusions are only applicable to funds that use a term like transition, social, or government. The PAP exclusions, on the other hand side, which are more extensive than the one under CTB, are applicable to the categories using environment, impact, or social. Digging just very, very quickly into those exclusions. So CTB exclusions means that a fund cannot invest in companies that are involved in any activities related, for instance, to controversial weapons, or when it comes to tobacco in relation to cultivation and production of tobacco. And for the PAP, there is also the CTB exclusions that are to be applied, but on top of that, funds are also not allowed to invest in companies that derive a certain percentage of revenues from certain sectors. So, last but not least, there is another requirement, again, not as simple as it is for the quantitative criteria, because actually the qualitative criteria are applicable depending on the category. So you have one particular qualitative criteria for sustainability-related terms, then one for transition and one for impact. And just to make it a little bit clearer, we laid down here in the slide just the differences actually between funds using a transition term and one using an impact term. So you can see here that when it comes to the qualitative requirement for transition-related terms, you need to be able to have a clear and measurable path to social or environmental transition. And when it comes to sustainability-related terms, the qualitative requirement is that the fund needs to invest meaningfully in sustainable investments. When is this all entering into force? So first of all, we have a first entry into force coming up 21 November 2024 for any funds that are set up and incorporated or formed as of that date. And then you have a transition period for any funds that have been in existence prior to 21 November, and that transition period goes up to 21 May 25. So there are practical challenges, of course, coming up with new rules. One of the main issues, and despite some significant pushback from the industry and also industry associations, is that closed-ended funds that have ceased to market will fall within the scope of the guidelines. And maybe, Laurent, you can dig a little bit deeper into the practical issues that may come with that.
Exactly. I mean, if it's a fund that's already closed or that has already started marketing, and you realize you're in one of these fund names that's under scrutiny, then you have to ask yourself the question, what do I do? Do I change the name, which can be quite complicated if it's already been marketed and being used for a while? Or do I actually align my investment policy with the fund name to be in compliance with the guidelines? So if it's not the case, it means that there might be a change to the investment policy, which could lead to more operational issues because you could have mandatory redemption rights for LPs who have invested in a certain investment policy. Now that there's a change of investment policy, they could get their interest redeemed, or you would need to seek LP consents. But also, more importantly, you might have to change the composition of your portfolio and sell some assets and buy some more to comply with these rules. So just by having this small change about the fund name, it could trigger a list of very, very important change for an active fund. Any other practical issues that you see, Lisa?
So as a lawyer, we love definitions. We love when things are clear. However, in the guidelines, not everything is so crystal clear like we would love being it. So for instance, controversial weapons, there is no definition laid out in the guidelines. So there may be some discrepancies in relation to that term. Also, when it comes to tobacco, what is excluded is the cultivation and production only. But what about the marketing or distribution of tobacco? This, however, is not excluded expressly. So we need to see how this is going to be interpreted. But there are, of course, certain issues and some operational challenges coming with new guidelines. But I'm pretty sure, Laurent, we also can take some opportunities out of it.
Yeah, of course. I mean, just coming back again on this, I think what would be the real risk with all of these policies is that instead of pushing funds to make actually more sustainable investments, it actually spook out funds for making them because they don't want to fall under more regulatory scrutiny and thinking they won't be able to comply with the rules. So, but thinking about this, when you look at how the market is pushing, there's a strong demand for real Article 8 funds, for Article 9 funds as well. So players on the market that actually promote genuine green funds that comply with these rules will definitely have a market advantage over their competitors. So there's a clear shift in the market. Of course, compliance, of course, disclosures is creating an administrative burden and can be extremely complicated. But if you make the switch now, definitely opportunities will arise and you will be able to better position yourselves for years to come. Oh. Any questions on this very, very broad topic?
Yes, we do.
Thank you for your presentation. Quite practical question. Do we know if these guidelines are going to extend to also mandates or even more generally, just the actual marketing of the practice of ESG investing? If I'm per se saying invests at my bank, we have this activity of ESG investing, would that fall on those guidelines in the future?
You want to start there?
Okay.
Yeah, I was going to say, for the time being, it's really just for funds themselves. But again, I mean, greenwashing is a very broad topic. So these guidelines in particular are really just for the funds. But it doesn't mean that you should be doing greenwashing anyway. But
No mandates as well?
Legally speaking, it's really applicable to ManCos managing UCITS and IFMs managing IFs. But of course, it cannot be excluded that A, the guidelines may be extended to broaden the scope, or that other associations are pushing and going to ASMA and saying, okay, but we need something similar also for other sectors.
Thank you so much for your presentation. I'm Claudia Hitai, Ministry of Environment. Can you give us, you'd given us already an idea of how many funds in Luxembourg would be affected by this, would be, in a sense, right now non-compliant. What do you think will be their choice to be more, actually increase their investments, so sort of to meet the naming guidelines, or to change their name? What do you think will be more likely?
you got the experience recently, I think, with an asset manager that was directly concerned, and maybe you can share your experience with how did you approach this guideline with them?
Sure. So I think there are two ways of approaching the issue. The thing is that exclusion lists in general are already extensively used by fund managers. It's basically, when it comes to ESG strategies, the primarily strategy used in the European market. So it may be that a lot of fund managers are already excluding investments based on an exclusion list, which can either be based already on the CTB or POP exclusion, depending on the term, or that it is not necessarily a burden for them to adjust the exclusion list that they are already using to do the switch. Now, of course, if there are funds that have, for instance, already or another example, you have an Article 8 fund that only committed 50% of making ERS-aligned investments. Making an adjustment from 50 to 80% is not that easy. So you need to analyze your whole portfolio. You need to ensure that the investment strategy, when including the exclusions, and especially when the exclusions have not already been embedded, are also applied, and maybe do a rebalancing of the portfolio. And maybe then it's easier just to change the name than just revamping your portfolio, your investment strategy, going to investors, asking for their consent, depending on whether it's a material change of the investment strategy or not. So I think, again, there are two ways of approaching the issue.
Just to complement this, I think changing the name might be the only way forward for funds who are just not compliant with it. So completely revamping your portfolio, as you said, if it's a fund that's fully deployed, can be quite complicated and could cause more concern than just simply changing the name, even though there is an administrative burden coming with it. Hopefully, going forward, the trend will be to be fully compliant from day one and then have an investment policy that matches the intention.
Any other questions? So thank you very, very much, both of you.
Thank you.